Hello everybody. February 24 REITs portfolio review. I sold IREIT and I sold ESR REIT finally. Over the past 2 months, I've been thinking a lot about what's happening around me. And of course, if you follow the SGX announcements, this one should be very familiar to you guys. Capital Pacific owed recapitalization, suspension of distributions. This comes right after Manulife REIT, and following that, Prime REIT also did something similar. I don't own any of these US commercial REITs. I don't have it right from the start. I never believed in it. There's some viewers who did some good trading though. This viewer, for example, blah blah here, and then bought at 8.7, sold, bought here and sold. So I think some guys can benefit from this REITs. But in general, I don't do a lot of all this trading. I believe in the buy and hold and collect dividend philosophy. So as I replied, I did put some money, a big chunk of my money actually, 30% of my portfolio into Capo back then, which I think worked out great. I don't intend to sell anything. I intend to ride this wave. I intend to see this Capo Corp turn into this global asset manager. I'm happy with it. So I don't own any of this US commercial REITs. All I want to say though is that if you look at what's happening, it's quite clear. Initially, when the Fed and the central banks were raising rates, it was a higher interest cost hitting bottom line issue, and now this is turning into a cap rate expansion, busting the gearings, alright, because as cap rates expand with interest rates going higher, the portfolio valuations decreases, therefore the gearing ratio rises, and this is gonna start busting the loan confidence, and therefore the REITs will have to find a way to sell assets and so on and so forth to repay the loans. And I think what's going to happen next is even more severe. It's going to be a credit crisis affecting the banks and turning, if not well managed, into a banking crisis. I'm not sure if a banking crisis will happen. It will really depend on whether or not the central banks act fast enough to contain the risk. But I think if you're not careful, this will turn into a whole chunk of a contagion risk. And don't think that this is just going to affect the banks, because if the banks are affected, they're not going to lend, and therefore it's going to be a credit crisis where the REITs will not find the ability to refi anymore. So you got to be careful about it. After thinking about it for a very long time and observing what's happening to Europe as well, because I think the US market is something you cannot touch. At least I'm not going to touch. If you're going to touch, that's your problem. I think the European market is going to go bust as well. Look at it, German banks, German insurers, all getting affected with the German housing sector in a confidence crisis. Look at the valuations of the REITs on the SGX with European exposures. I think the REITs, the European property sector cap rates has expanded roughly by 100 basis points. I'm not sure if that's the end. I think with the impending European recession, things are gonna get worse, and cap rates are continue to expand. Actually, I think that's what's gonna happen. I think the Western property sector is in a big problem with the low rates for the past decade, and now everything's gonna reverse, and this is not gonna end. With that in mind, I've been thinking hard and fast about the entire portfolio, thinking about how to trim it. Especially now that the REITs portfolio has risen quite a fair bit actually, making quite a fair bit of money for me. I'm decided that I have to get rid of things that I'm not confident about and to shake up the portfolio. So this is what I did. This is the portfolio I had at the end of December 2023. And if you notice, I've already gotten rid of all my capital REIT, which I talked about it last year actually. All my capital REIT is gone because I think the cap rate of the Singapore commercial, Singapore office assets are too low. In view of what's happening to the rates, I still hold my view that rates are going to stay higher for longer. I think the Fed will cut, but I think it will be cutting in the second half of the year before the US elections, because they cannot be cutting during the elections for fear of accusations from Donald Trump and Biden. I think though they are not going to cut to 1.5%. They'll keep rates at maybe like 2.5% to 3%. And I think a lot of people are thinking that they're going to cut to zero. I don't think that's going to happen at all. So I think the Fed will cut second half of this year before the elections, but they're going to keep rates higher for longer at roughly 2% to 2.5%. I think that's a terminal rate. And that is the basis on which I think of things. The first thing that I did was to sell 20% of my REITs portfolio. So the REITs portfolio, I've sold 20% of it. The first thing that I did was to sell my IREIT, because if you look at what's happening around the world, and I said just now, the European property market is probably gonna get even worse. I think this is too big a percentage for me to hold in the first place. I'm not sure what I was thinking about in having 17% of my REITs portfolio in IREIT. It was too high, it was too much. I'm still thinking that the assets are undervalued. I am particularly quite confident about their Berlin property, but I think the repositioning of the assets will take quite a long time, and I'm not sure if I'm willing to wait that long, especially with all the risks around me and the uncertainty. So I sold a whole bunch of it at 41.5 cents. I had bought this. I have bought this REIT at during the rights issue at 40.8 cents. So net overall, I made a small capital gain, and I think I got some dividends as well. But I think on the average, I'll just call it flat, and that I break even. That's all. So I reduced the positioning to 5%. I still think that it's undervalued. I still think that the yield is attractive, but the impending departure of the key tenant at the Berlin campus and the time taken to reposition the asset gives me a lot of uncertainty, especially with what's happening around me in the German real estate sector. So therefore, I reduced the weightage by really a lot. Second thing that I did was to sell ESR Logos REIT, which has been an absolute disappointment to me. As of December 23, it was 7%, but actually this year, for the past 2 months, it has rallied a lot. I think the REIT manager started to buy back their shares, and the market just went a lot higher, which was a very good opportunity for me to actually get rid of it. I think the weightage actually went from 7% to like 10% of my portfolio, and I sold a whole bunch of it at 31.5 cents. Now I have 5% of it in my portfolio. When I bought the REIT during the rights issue at around 32 cents, I think. So I bought the rights issue at 32 cents. Actually, I didn't take part in the rights issue. I bought below the rights price from the open market at around 32 cents, I think. I sold at 31.5 cents. So I realized a capital loss, but I think I garnered around 2 rounds of dividend. So overall, for the 6 months of holding period, I gained around like 5 to 6%, which was nothing much to scream about. But I'm happy to get rid of it because I've been absolutely disappointed with what's happening. When I bought the REIT during the rights issue, I was thinking they will be able to divest their assets, around 6 to 700 million of it, at a higher than book value. Because if you look at the warehouses that are in demand and logistics that were in demand, I thought they'll be able to sell a whole bunch of it away, and then above book value, and therefore they will raise the NAV, and therefore after that reposition and recycle the capital. What happened was an absolute disappointment. They sold much fewer than what I had expected, and they sold it below book. I was completely amazed by the abysmal divestment effort. So the whole investment hypothesis has now been ruined, and so a whole bunch of it away to reduce my risk to just 5%. I still think that I'm not very sure actually. I've lost confidence in this REIT actually, but I still think it's pretty cheap. But if the REIT rallies to around 38, 39 cents, I'll be happy to sell everything and get rid of it, and I'll never touch this again in my life. But I still keep a bit of it because I still think it's cheap though. But I'll be happy to sell it on any rally up to around 40 cents, maybe even 38 cents. I'll sell it. What happened after that was that I bought using the proceeds from the sales Far East Hospitality at 64 cents before the dividend. So now this fella is at 9%. I'm still pretty confident about the tourism sector and hospitality. Look at the STB. I'm quite happy with the way they managed the Taylor Swift concerts, Coldplay. I'm not sure who else is coming with maybe more sporting events as well. I love the government. I love STB. I think they are really trying to make Singapore into a really hype and a hit place. So I like the exposure, and all the properties are in Singapore, right, where they have no cap rate expansion, no nothing. I also bought a whole chunk of UOB. I think this was bought in early January when markets were thinking that the Fed will cut rates and therefore banks will all go crazy. I think the names will suffer, but I quite like the acquisition of UOB into the Citibank Southeast Asian assets. I think the organic growth will be quite good. I like the way the Wee family is managing UOB. Very prudent, very confident, very conservative. So I think this is not that expensive with an NAV around $26. So it's just around 1.1 plus of book with a very good growth potential in ASEAN and stuff. Especially when these guys are ASEAN focused, they don't have a whole chunk of stuff in China. I think it's just been crazy, right? What's happening with Xi Jinping and all his CCP nonsense. So I'm quite happy with UOB. This is now a very, very big position in my portfolio together with Capital Corp. And I further intend to use all the proceeds of the dividends from the REITs to buy more and more solid companies with good cash holdings. I also bought Capital Land Investments at 2.79. Now that people were like thinking that I think what's happening is that the people are worried about the exposure of these guys to China properties, and they did announce that there will be some revaluation losses. And you see the market is now like crazy shorting the shit out of this stuff. When the market is selling stuff and they are shorting a lot, I like to buy whatever they are selling. And I think this guy is probably a good thing for the long run. Still pretty good asset managers, and the ability to recycle REITs into all the different recycle assets into the different REITs. I think this is quite a good buy actually. So you can see that I'm selling all the REITs away to buy the managers and asset rich companies. So I also bought CLI at 2.79, quite nicely I think. I'm quite happy with it. The rest of it actually didn't do much actually. The rest of it is just so there's a ratio, right? So there's a numerator and the denominator. The denominator got lower because I sold the REITs, and the numerator got higher because of the appreciation of the share price. So you see, AIMS Impact has appreciated in share price. Therefore, it's now 12.5%. Clint has appreciated slightly, so it's now 8%. MIT appreciated slightly, 16%. Star Hill is roughly the same, maybe a slight appreciation, so 16%. CLCT has remained a complete disappointment. I think China is like everybody's most hated country right now, so it's still at 10%. FLCT has done nowhere. I think the market is also concerned about the European exposure they have. I did think about the European exposure they had, but I think logistics is still okay. And more importantly, the gearing is very, very low. It's just like 30%. So even if there's a massive write down in the assets, I think there's a lot of headroom before they hit the 40%. So I'm quite confident with it actually. And I think this guy is actually quite well managed, and the assets are actually very, very good quality. So the rest of it, I just bought some more Ascot at 92.5 cents. And I think I bought more at 92 cents yesterday actually. So now this value went up to 7%. I'm still quite happy with the exposure. I think the ability of them to sell the assets around 4% cap rate recently is quite decent. And they actually managed to renew their leases in the French properties, but quite a fair bit of positive reversion. So I think although they have assets in Europe, but these hospitality assets are actually quite well demanded, and therefore I don't think there's going to get into any trouble anytime soon. So this is the portfolio update that I have in February. Quite a lot of reshuffling going around. Massive massive selling off in IREIT and ESR to recycle into more quality assets. You can see the portfolio has shrunk over the past maybe 6 months to much higher quality names with much lower risk going ahead. So for the rest of the viewers, I will urge you guys to just look through your portfolio and think closely and at the overseas assets that you have, especially those in the US and Europe, and think about it. Do you really want it in your portfolio? And what kind of risk do you have moving ahead for the rest of the year? So do think about it. Alright.